Listen up, because I'm only going to explain this once, and frankly, I'm doing you a bigger favor than your financial advisor ever has. It's January 16th, 2026, and while you were probably hitting snooze for the third time or scrolling through whatever garbage your algorithm fed you this morning, the silver market just experienced what I can only describe as a masterclass in institutional robbery. And before you ask, yes, I was awake. Yes, I was watching. And yes, I called this exact move 3 weeks ago in my premium newsletter that apparently none of you bothered to subscribe to. I'm William Lee, and I'm here to help you understand why you're about to make the biggest financial mistake of your life if you don't pay attention to what I'm about to tell you. No pressure. Let me paint you a picture of what went down while America's retail traders were dreaming about Lamborghinis and beach houses they'll never afford because they keep falling for the same traps over and over again. At 3:23 a.m. Eastern, which, by the way, is a time I'm intimately familiar with because I actually take this seriously, silver was trading at a comfortable $89.40. Everything looked peachy. The tape was cleaner than your conscience after church. Volume was average. Nothing seemed unusual, which should have been your first clue that something was about to go spectacularly wrong. And then, at precisely 3:47 a.m., the floor dropped out, not metaphorically, literally. Silver went from 89.40 to 87.80 in 17 minutes. 17. That's less time than it takes most of you to figure out what you want for breakfast. A 1-60 plunge, nearly 2% of the entire value, evaporated faster than your New Year's resolutions. I'm sure that felt great for anyone who was long and had their stops set at, please take all my money, thanks. But here's where it gets interesting, and this is where I separate myself from every talking head on CNBC who couldn't trade their way out of a paper bag if you gave them a map and a flashlight. That wasn't panic. That wasn't some fundamental shift in the silver market where suddenly the industrial world decided they don't need conductors anymore. That wasn't even real selling in the traditional sense. That was a surgical strike. That was a liquidity hunt executed with the precision of a Swiss watchmaker and the morality of a mob boss. That was the big boys, the institutional sharks, the bullion banks, the people who actually know what they're doing, going fishing in waters filled with gullible retail minnows. And boy, did they catch a haul. We're talking billions, that's billions with a B, in stop losses triggered at $87.80. All those clever retail traders who thought they were being smart by placing their stops just below $88. All those algorithmic hedge funds with their fancy computers and their PhDs who still don't understand that the market doesn't care about your risk management spreadsheet. All those smaller institutions whose compliance departments mandated stops at reasonable technical levels, every single one of them got liquidated in that 17-minute window of pure carnage. And you want to know the best part? The absolute cherry on top of this beautiful sundae of market efficiency? The same players who engineered the drop were on the other side buying every single ounce. This is how the game works, ladies and gentlemen. This is the jungle. And if you think you're swimming with dolphins, let me be the first to tell you, those aren't dolphins. Those are sharks, and you look delicious. Now, before you accuse me of being some conspiracy theorist ranting from his mother's basement, which I'm not, because I own my house outright, thank you very much, paid for by understanding exactly what I'm about to explain to you, let me break down the mechanism. Consider this your free education from William Lee, because God knows you're not getting this from your broker. Liquidity in markets works exactly like gasoline in a Ferrari. You can have the most powerful engine ever built, you can have 12 cylinders of pure Italian engineering, but without fuel, that beautiful machine is nothing more than an expensive paperweight. The silver market operates on the same principle. The institutional players, the ones moving billions, not thousands, they need liquidity to fuel their moves. And where do they get that liquidity? From you. From your stops, from your panic, from your complete and utter lack of understanding about what's actually happening. Here's the specific play that just unfolded, and I want you to tattoo this on your forehead because it's going to happen again, probably next month, and you're going to fall for it again unless you wake up. The bullion banks knew, and I mean they knew with absolute certainty, that there were massive clusters of stop losses sitting at $87, $80. How did they know? Because they have access to order flow data that you and I will never see. Actually, scratch that, I see it. You don't. They can see the entire market structure laid out like a buffet. It's like playing poker when you can see everyone else's cards while they're blindfolded and also slightly drunk. So what did they do? They coordinated a sell program during the thinnest part of the market, early morning, low volume, before New York's even had its first coffee, and they pushed price down with surgical precision, specifically to trigger those stops. When those stops got hit, they became market sell orders. Those market sell orders pushed price down further. That triggered more stops. Those triggered more stops. It's a self-reinforcing cascade, a beautiful death spiral that the banks themselves started. And they're buying every single ounce that panicked sellers are dumping at increasingly desperate prices. This is accumulation disguised as distribution. This is strength masquerading as weakness. And this is exactly what I've been telling my premium subscribers to watch for. though I suspect most of you are still reading the free content and expecting champagne insights on a beer budget. Now here's where it gets really interesting, and this is where you need to channel your inner adult and pay very close attention, because the next few hours are absolutely critical to your financial future. After that drop to $87.80, silver has been grinding. As I'm recording this at 6:47 a.m., yes, I'm actually working while you're sleeping, we're trading at $88.15. We bounced about 35 cents off that low, but we haven't reclaimed $89 yet. And there's a very specific reason for that has nothing to do with fundamentals and everything to do with the fact that the sharks are deciding whether they got enough lunch at $87.80 or whether they need to make one more trip down to $86.40 for dessert. Let me explain why $86.40 matters and try to keep up, because this is where most people's eyes glaze over right before they lose money. If you actually bothered to pull up a chart, and I know that's asking a lot, you'd see there's another massive cluster of liquidity sitting at 86 and 40. These are stops from all those brave traders who bought silver at 85, thinking they got a great entry because they read some blog post about buying dips, and they placed their stops just below at $86 or $86.50 because that's what some YouTube video told them was smart risk management. These are also stops from swing traders using the recent low as their line in the sand, which is trading jargon for please take my money here. The total notional value sitting at that level? Absolutely massive. We're talking billions more in potential liquidity just sitting there, waiting to be harvested like wheat in a field that doesn't know it's harvest season. So the question every professional trader is asking right now, and by professional I mean people like me who actually make money doing this, not the guy who made $500 on GameStop and now thinks he's Warren Buffett. The question is, did the banks get enough fuel at $87.80 to launch silver higher, or do they need to make one more run down to $86.40 to really fill the tank? And I'm going to tell you exactly how we're going to know the answer, because unlike everyone else talking about silver today, I actually know what I'm looking at. Watch the price action between now and the New York Open at 9:30 a.m. If silver can reclaim $89 and hold it into the US session, that tells me the accumulation at $87.80 was sufficient. The banks got their liquidity, they loaded the boat, they're ready to squeeze everyone who sold at $87.80 and make them watch in agony as silver rockets higher. But if silver continues to grind sideways or starts to drift lower, especially if we break back below 87.80, then buckle up buttercup because we're going to 86.40. That's where the real carnage will happen. That's where the final stop hunt takes place. That's where the last weak hands get shaken out before the bull market resumes in earnest. And here's what's going to blow your mind. Both scenarios are bullish. I know that sounds counterintuitive, which is why you need me to explain it to you like you're 5 years old. Both scenarios are bullish for silver. If we rip higher from here, fantastic. The banks have their liquidity, and they're ready to push for new highs. If we drop to 86.40 first, even better, that's an absolute gift entry for anyone with enough brain cells to understand what's happening. Because when they sweep that final pool of liquidity, when they trigger all those stops at 86.40 and silver briefly touches 86 or even $85.50, that's not the beginning of a crash. That's the end of the accumulation phase. Let me give you a concrete example from history so you can see this pattern clearly, because apparently nobody studies history anymore, and everyone thinks they're the first person to discover trading. Back in August 2020, gold was trading around $230. It had just made new all-time highs. Everyone was bullish. Financial Twitter was insufferable. And then overnight, in a single session, gold dropped $100 to $119.30. Retail traders panicked. The financial media called it a correction and started writing obituaries for the gold bull market. Everyone who had their stops at $119.50 or $119.75 got absolutely destroyed. And you know what happened next? Within 3 weeks, gold was back at $2,070, making new highs. That drop to $1,930 wasn't distribution. It wasn't the end of the bull market. It was accumulation. It was a liquidity sweep. It was the smart money loading up while dumb money was selling in panic. And the exact same pattern is playing out in silver right now. Same movie, different actors, but I've seen this film enough times to know how it ends. The reason I'm so confident about this, the reason I'm taking time out of my morning to record this instead of sleeping like a normal person, is because I've seen this movie before, multiple times. I know every scene, I know every plot twist, I can quote the dialogue, and I want to make absolutely sure that anyone listening to this doesn't get shaken out right before the big move, because that's what the banks are counting on. They're counting on you seeing silver drop to $87.80 or potentially $86.40. They're counting on you getting scared. They're counting on you making emotional decisions. They're counting on you selling at precisely the worst possible moment. And they're counting on accumulating your position at a discount before they launch this thing to levels that are going to make $89 look like a distant memory. Now let me explain why today specifically is so dangerous and so important, because there's another layer to this onion that's going to make you cry. Today is January 16th, 2026. It's the third Friday of the month. You know what that means? Of course you don't, because you don't actually study markets. You just trade them. It's monthly options expiration, OPEX. This is the single most volatile day of the month for silver and gold. It's like the Super Bowl, except instead of touchdowns, we have psychological warfare and institutional manipulation. Why does OPEX matter? Because there are billions of dollars in derivative contracts that expire today at 1:30 p.m. Eastern. All those call options and put options at various strike prices that retail traders bought thinking they were going to get rich quick, they all settle today. And the market makers, the big institutional players who sold those options, they have a massive incentive to make sure those options expire worthless. Because if those options expire worthless, the market makers keep 100% of the premium. That's free money. That's the business model. Here's how it works, and I'm going to use small words. Let's say some retail trader bought call options at the $90 strike price, probably after watching a YouTube video about explosive silver breakout imminent. That means if silver closes above $90 today, that option is in the money and the option seller has to pay out. But if the option seller can push silver down to $89 or $88 or $87, which spoiler alert, they can and they will, then that call option expires worthless and they keep the entire premium. Multiply that by thousands of contracts, millions of ounces of notional exposure, and you're talking about billions of dollars in profit or loss based purely on where silver closes today. So the game being played today is this. The market makers are going to do everything in their power to pin silver at the level that causes maximum pain for option buyers. If there are huge clusters of call options at $90, $92s, and $95, they're going to fight like hell to keep silver below $90. And if that means taking silver down to $87s or $86 to shake out weak hands and reset the technical picture, they'll do it without a second thought, without hesitation, without remorse. This is not manipulation in an illegal sense. Calm down, SEC. This is how derivative markets function. The players with the most information and the most capital control where price goes on expiration day. That's not a bug, it's a feature. And if you don't like it, maybe don't trade options against people who literally write the playbook. But here's the thing that gives me confidence, the thing that makes me absolutely certain that this is just noise and not signal. Silver has been in a structural bull market since early 2025. We're up over 140% from the lows. Let me repeat that for the people in the back. 140%. Industrial demand is at all-time highs. Supply deficits are real and getting worse every quarter. Central banks around the world are diversifying away from the dollar like it's going out of style, which, by the way, it kind of is. And the macro backdrop, inflation, currency debasement, geopolitical instability, all of it points to higher precious metal prices like a neon arrow in the dark. So while the banks can play their games on OPEX, while they can hunt stops and pin price for a day or a week, they cannot change the underlying fundamentals. They can't print more silver. They can't make new mines appear overnight. They can't erase supply deficits with clever trading algorithms. The math is the math, and the math says silver is going higher. And that's why I say this with complete conviction, not hope, not wishful thinking, but actual analytical conviction backed by 12 years of experience and a track record you can verify. Silver is going higher. Not maybe, not hopefully, not if conditions are right. It's going higher because the math demands it. The fundamentals require it. The physics of supply and demand mandate it. The only question is whether we go straight up from $88 or whether we make one more dip to $86 to fuel the move. Either way, by the time we look back at this moment in February or March, this morning's drop to 87 or 80 is going to look like the gift of a lifetime, and you'll be kicking yourself for not listening to William Lee. Now let me tell you about a concept that's going to revolutionize the way you think about trading, assuming you actually think about trading instead of just randomly pressing buttons and hoping for the best. This concept took me years to fully understand, cost me probably 6 figures in tuition to the market, and it's worth more than anything you'll ever learn from a textbook. The concept is this: you have to enter the market when others are being forced out. You have to buy when others are losing. You have to position yourself where others have their stop losses. This is the single most important piece of trading wisdom I can give you, and it goes against every instinct you have as a human being. Think about it. When silver drops from $89 to $87.80 in 17 minutes, what's your natural response? Fear, panic, sweaty palms, the overwhelming urge to sell before it gets worse. The thought that maybe you were wrong, maybe silver is going to crash, maybe you should cut your losses and live to fight another day. That's human nature. That's evolution. We're programmed to avoid pain, to run from danger, to protect what we have. It kept our ancestors alive on the savannah when lions were chasing them. But in the markets, that instinct will absolutely destroy you, because the moments of maximum fear, the moments when it feels like the sky is falling and everything is going to zero, those are exactly the moments when the big money is accumulating. Those are the moments when wealth transfers from weak hands to strong hands. Those are the moments when fortunes are made. Warren Buffett has a famous quote that everyone likes to repeat at cocktail parties to sound smart: be fearful when others are greedy, and greedy when others are fearful. But most people think that's just a cute saying. They nod their heads. They agree with it in principle. But they don't actually practice it. They can't. Because when fear is running through your veins like ice water, when you see your position down 5% or 10%, when you hear the financial media talking about corrections and pullbacks and concerning technical damage, it takes incredible discipline to do the opposite of what your instincts are screaming at you to do. But that's the game. That's the edge. That's how you separate yourself from the 90% of traders who lose money and join the 10% who actually profit. You have to train yourself, and I mean literally train yourself like you're Pavlov's dog, to see a drop to 87.80 and think opportunity. You have to see stop losses getting triggered and think, that's exactly where I want to be buying. You have to see everyone else panicking and think, this is where wealth is transferred from the weak hands to the strong hands, and I'm going to make damn sure I'm a strong hand. I've built my entire trading career on this principle. Every time there's a violent move against the crowd, every time there's a stop hunt, every time there's a liquidation cascade, I'm watching to see where the smart money is accumulating. And right now, at $88.15 silver, with the potential for one more dip to $86.40, this is exactly the kind of setup I live for. This is the kind of setup that makes me excited to wake up at 3:30 a.m. This is the kind of setup where you can enter a position that goes on to make 30%, 50%, 100% returns, while everyone who sold at $87.80 is watching from the sidelines, kicking themselves and blaming manipulation. Let me give you the specific game plan I'm using today, and remember, this is not financial advice, because apparently I need to say that even though we all know you're going to trade based on what I'm telling you anyway, this is just how I'm navigating this market based on 12 years of experience, a track record that speaks for itself, and access to data that most retail traders don't have because they're too cheap to pay for real information. First, I'm watching $89 like a hawk watches a field mouse. If we can reclaim $89 and hold it for more than 30 minutes, not just spike above it and immediately get rejected like you at prom, especially if it happens during the London session before New York opens, that's a very bullish signal. That tells me the accumulation at 87.80 was sufficient and we're ready to move higher. In that scenario, I would expect silver to test $91-92 by this afternoon, and everyone who sold is going to feel that special kind of pain that comes from being paper-handed. Second, if we continue to grind sideways or drift lower, if we break back below 87.80, then I'm watching for the final sweep down to 86.40, like it's the only thing that matters. And if we get that move, if I see silver briefly touch $86 or even $85.50, I'm going to be very aggressive on the buy side. Not with 100% of my capital, I'm not stupid, despite what my ex-wife might tell you, but with a meaningful position size that reflects the probability of this being the final shakeout before the real move. Because if 86.40 gets hit and we don't get follow through to the downside, if we bounce hard off that level, it confirms that was the final liquidity grab, that was the bottom. And the next move is going to be violent to the upside. Third, I'm completely ignoring the noise today. And by noise, I mean pretty much everything. I'm ignoring whatever CNBC says because they don't know anything and they're reading from a teleprompter written by someone who's never traded a day in their life. I'm ignoring the Twitter traders who are screaming about silver crashing because they bought at $89.30 with 10x leverage and are now liquidated. I'm ignoring the permabulls who say every dip is manipulation and the permabears who say every rally is a trap. I'm focused purely on price action, volume, and market structure. Those are the only three things that matter. Everything else is just entertainment. And fourth, I'm prepared for extreme volatility around the 1:30 p.m. Eastern options expiration. That's when the real fireworks happen. That's when we'll see if the market makers successfully defended their key strike prices or if the bulls somehow managed to break through. The hour between 12:30 and 1:30 p.m. is going to be absolute chaos. Expect whipsaws. Expect fake moves. Expect the kind of volatility that makes you want to close your trading platform, unplug your computer, and go for a long walk. But if you can stay calm, if you can stick to your plan, if you can see through the manipulation and the noise, that's where the opportunity is. That's where fortunes are made. Now let me zoom out and talk about why this matters in the bigger picture, because this isn't just about one day of trading or one stop hunt or one liquidity sweep. This is about understanding where we are in the silver market cycle and what's coming in the weeks and months ahead. And trust me, what's coming is going to make today look like a footnote. Silver had an extraordinary year in 2025. We went from the low 30s all the way up to $93 at the peak. That's a 140% plus gain in a single year. It was one of the best performing major assets in the entire world. Better than most tech stocks, better than most cryptocurrencies, better than pretty much anything except maybe some penny stock that got pumped on Reddit. And yet, If you talk to the average person on the street, if you ask them what they know about silver, most of them have absolutely no idea this move even happened. They're still worried about their 401k that's probably underperforming cash. They're still listening to their financial advisor who told them to buy a balanced portfolio of bonds that are getting crushed by inflation. They have no clue that one of the greatest bull markets in modern history is happening right under their noses. That's because we're still in the stealth phase of this bull market. The institutions know what's happening. The smart money knows what's happening. The people who actually study commodity markets and monetary policy, people like me, William Lee, your humble guide through this financial wilderness, we know what's happening. But the mainstream, the retail public, the casual investor who thinks diversification means owning both Apple and Microsoft, they're completely oblivious. They're still focused on whatever the financial media is pushing this week, and that's absolutely perfect. Because the real money in any bull market is made before the crowd shows up. Think about Bitcoin in 2016 and 2017. When Bitcoin was at $1,000 or $2,000, most people had never even heard of it. The gains from $1,000 to $10,000 happened before your uncle at Thanksgiving was talking about crypto. By the time Bitcoin hit $20,000 and everyone and their grandmother was trying to open a Coinbase account, the easy money had already been made. The early adopters were already rich. The latecomers got to hold bags. The same pattern played out in tech stocks in the late 1990s. The same pattern played out in gold from 2001 to 2011. The same pattern played out in oil, in real estate, in every major bull market in history. And the exact same pattern is playing out in silver right now. We're at that perfect stage where the chart looks incredible, where the fundamentals are screaming, where anyone paying attention can see what's happening, but the masses haven't figured it out yet. That gives us time. That gives us opportunity. That gives us the chance to position ourselves before the herd arrives. But it also means we have to have the courage to act when no one else is. We have to be willing to buy when it feels uncomfortable, when the price is dropping, when the headlines are negative, when your spouse is asking why you're investing in shiny rocks instead of index funds. Because by the time it feels comfortable, by the time everyone agrees that silver is going higher, by the time it's safe and consensus and your financial advisor is recommending it, the move will be over. You'll be buying at the top, and you'll be the bag holder for the next cycle. Let me talk about the supply-demand fundamentals for a moment because this is crucial context and because unlike most people talking about silver, I actually understand how commodities work. The world has been running a silver deficit for 6 consecutive years. That means global consumption exceeds global production. We're drawing down above-ground inventories to meet demand, and those inventories aren't infinite. They're not magical. They're not going to replenish themselves. Every year that we run a deficit, the available stockpiles get smaller. Eventually, and this is simple math that even a third grader could understand, we hit a point where there simply isn't enough silver to meet industrial demand at current prices, and the demand side is accelerating. Solar panel production is exploding as countries try to transition to renewable energy, which is hilarious because most of them are using coal plants to manufacture the solar panels. But I digress. Every single solar panel requires silver. There's no substitute that works as well. Electric vehicle production is ramping up, and EVs use significantly more silver than traditional cars. 5G infrastructure is being built out globally, and that requires massive amounts of silver for the electronics and conductors. Medical applications, water purification systems, semiconductor manufacturing, all of it requires silver. Meanwhile, on the supply side, we're not bringing new mines online fast enough to meet this demand. Why? Because for the last 30 years, silver was kept artificially cheap by various market mechanisms that we don't need to get into, but that definitely weren't manipulative, wink wink. When silver was trading at $15 or $20 or even $25, it wasn't economic to develop new primary silver mines. Mining companies focused on gold or copper or other metals and treated silver as a byproduct, so the pipeline of new supply is basically empty, barren, a wasteland. Even if silver stays at $90 and mining companies decide to develop new projects tomorrow, those projects won't produce an ounce of silver until 2030 or later. It takes 5 to 10 years to bring a new mine from discovery to production. You have to find the deposit, you have to do the geology, you have to get permits, you have to build infrastructure, you have to hire workers. It's not like you can just flip a switch and start mining silver. Do you see the setup here? Let me spell it out for you, since apparently everything needs to be explained in crayon. Demand is accelerating, supply is constrained, inventories are declining, and the price is still only at $88. That's not a problem, that's an opportunity. That's a massive mispricing. The market hasn't fully absorbed the reality of what's coming. And when it does, when the industrial buyers start to panic about supply security, when the investment community finally wakes up from its collective coma, the price is going to move in a way that feels parabolic. We're talking moves that make you check your screen 3 times to make sure there isn't a glitch. Now I want to address something that I know some of you are thinking, because I can read your minds and also because people ask me this constantly. But William, what about manipulation? What about the big banks? Won't they just keep capping the price forever? This is a fair question. It's actually one of the smarter questions I get, which tells you something about the average quality of questions I receive. So let me give you my perspective based on years of watching these markets and actually making money in them. Yes, there is manipulation in precious metals markets. This is documented. This is not conspiracy theory. This is legal fact. There have been fines. There have been lawsuits. JP Morgan paid nearly $1 billion for spoofing the gold and silver markets. So when I talk about manipulation, I'm not wearing a tinfoil hat, I'm reading court documents. But here's what people get wrong, and this is crucial. Manipulation doesn't mean the price can never go up. Manipulation doesn't mean silver is going to $10. Manipulation means the price moves are more violent, more volatile, and more engineered than they would be in a truly free market. The banks can cap rallies temporarily. They can engineer sell-offs to hunt stops like the one we saw this morning. They can create the appearance of weakness when there's actually strength. But they cannot stop the underlying fundamentals forever. They can't print more silver. They can't magically increase supply when there are deficits. They can't change the fact that industrial demand is real and growing every quarter. They can't make Chinese buyers stop buying. They can't make solar panel manufacturers stop needing silver. The laws of physics and economics are more powerful than even the biggest banks. So what happens is this. The banks suppress price for as long as they can, accumulating physical metal at artificially low prices like smart shoppers at a Black Friday sale. But eventually, the physical market breaks away from the paper market. Eventually, premiums on physical silver get so high that the disconnect becomes obvious even to casual observers. Eventually, delivery demands overwhelm the available inventory. And when that breaking point comes, and it always comes, the price doesn't just go up. It explodes. It gaps. It moves in ways that leave technical analysts speechless, because all the suppression, all the manipulation, all the artificial capping just created a pressure cooker. And when the lid blows off, the move is violent. The spring uncoils. And everyone who was positioned correctly makes generational wealth, while everyone else is still trying to figure out what happened. That's what I believe we're setting up for in 2026. The suppression mechanism is starting to fail. You can see it in the fact that silver has held above 85 by dollars despite multiple attempts to push it lower. You can see it in the fact that physical premiums remain elevated. You can see it in the fact that industrial users are getting nervous about supply and locking in long-term contracts at prices they would have laughed at 3 years ago. The pressure is building. The lid is starting to rattle. And what happened this morning at $87.80? That wasn't the banks crushing silver permanently. That was them desperately trying to grab as much liquidity as possible before they lose control completely. Let me tell you about one more critical factor that most people are completely ignoring because they're too busy watching TikTok videos about day trading, the Shanghai Premium. Right now, as I'm recording this at an ungodly hour because I'm actually serious about this business, silver is trading around $88 in New York and London. But in Shanghai, the price is significantly higher. We've seen Shanghai premiums of $5, $10, even $15 per ounce above Western prices. Why does this matter? Because it tells you where the real demand is. It tells you who's actually buying physical metal instead of paper contracts. Chinese buyers are willing to pay substantially more for physical silver than Western markets are pricing it at. That's not a small detail that you can ignore. That's a massive signal screaming at you about what's actually happening in the physical market while you're staring at charts of paper contracts. The Shanghai Premium exists because China is accumulating. Their industrial sector needs silver for manufacturing. Their government is diversifying reserves away from dollars because apparently they don't trust Jerome Powell to stop the money printer. Shocking, I know. Their citizens are buying silver as a store of value because they're smart enough to understand that paper currency isn't actually wealth. And because there are capital controls and import restrictions, silver that makes it into China trades at a premium to silver sitting in Western vaults. This creates an arbitrage opportunity for anyone who can physically move metal from west to east, and that arbitrage flow is draining Western inventories like water through a sieve. Eventually, one of two things happens. Either Western prices rise to close the premium gap, or Western vaults get completely drained and we have a supply crisis. Both scenarios are wildly bullish. The first scenario means silver in New York and London rallies to match Shanghai prices. That's potentially 100 plus in silver in the very near term. The second scenario means physical shortages, delivery failures, and a complete breakdown of the paper pricing mechanism. That's potentially 150 plus or silver or even higher as the market reprices based on actual physical availability rather than paper contracts that may or may not be backed by real metal. And here's the kicker that should make you sit up straight. The big institutional players know this. The bullion banks know this. The hedge funds know this. Goldman Sachs knows this. Every smart money player in the world knows this. That's why they're playing these games with stop hunts and liquidity sweeps. They're trying to accumulate as much physical metal as possible before the market fully realizes what's happening. Every time they push price down to 87.80 or 86.40, every time they trigger a cascade of stop losses, they're buying. They're accumulating. They're loading the boat. They're positioning for what's coming. So when I see silver drop 160 in 17 minutes, I don't see fear. I don't see weakness. I don't see the end of the bull market. I see opportunity. I see the sharks feeding. I see smart money accumulating. And I know that if I can position myself on the same side as the sharks, if I can buy when they're buying instead of selling when retail is panicking, I'm going to be on the right side of the move that follows. And that move is going to be spectacular. Now, let me give you the practical takeaway, the actionable intelligence you can actually use right now, instead of just reading this and doing nothing like most people. If you own physical silver, do nothing. Hold. This is not the time to panic. This is not the time to sell because you saw a $1.60 drop and got scared. Your physical silver is your insurance policy, your monetary hedge, your protection against currency debasement and government incompetence. You don't sell insurance the day before the hurricane hits. You hold it, you keep it, you thank yourself later for having it. If you're looking to add to physical holdings, wait and see if we get that final dip to 86.40. If we do, that's your entry. That's your chance to buy at a level we may genuinely never see again. Because once the supply crisis hits, once the physical market breaks away from the paper market, once the masses figure out what's happening, you're not going to be able to buy physical silver at $86. You might not even be able to buy it at $120. If you trade silver futures or mining stocks, and honestly, if you're trading futures, you should probably already know all this, but I'll explain it anyway. Here's the level I'm watching. $87.80 was the first liquidity hunt. If we reclaim $80 and hold, we're probably done going down and ready to move significantly higher. But if we break back below $87.80, then $86.40 is the target. At that level, I would be a very aggressive buyer with tight stops just below. Why? Because if they sweep 86.40 and we don't get follow through to the downside, if we bounce hard off that level, it confirms that was the final liquidity grab. That was the bottom of this consolidation. And the next move is going to be violent to the upside. For mining stocks specifically, remember the operating leverage I've been preaching about for months. These companies have all-in sustaining costs around $30, $40 per ounce, depending on the operation. At $88 silver, they're printing money. At $100 silver, they're printing obscene amounts of money. At $120 silver, their profit margins will be unlike anything we've seen in a decade, possibly ever. And yet the stocks are still priced as if silver was at $50 or $60. That disconnect is the opportunity. That mispricing is where generational wealth is made. That's where you get 10-baggers. Here's what I'm watching in mining stocks today. I want to see relative strength. If silver drops to 86.40 and the mining ETFs only drop half as much or even hold steady, that's incredibly bullish. That's the market telling you that despite the commodity pullback, the companies themselves are being fundamentally revalued. That's the beginning of the catch-up rally. And when that catch-up rally accelerates, when the institutions finally start rotating capital into precious metals miners, the moves are going to be absolutely violent. We're talking 20%, 30%, 50% gains in individual names over a matter of weeks, not months. But you have to have the stomach for it. You have to be able to watch your positions go down before they go up. You have to be able to sit through the volatility without panic selling at the bottom. Because the banks are going to do everything they can to shake you out before the real move. That's their business model. That's literally how they make money. They accumulate from weak hands and sell to strong hands at much higher prices. Your job, your only job, is to make sure you're a strong hand. Your job is to not give them your shares at $87.80 only to watch silver go to $110 or $130 over the next 3 to 6 months while you're sitting on the sidelines with nothing but regrets. I'm William Lee. I'm here to help you navigate this market, and I'm telling you with absolute certainty the opportunity is right in front of you. The market just gave you a gift this morning by dropping price and shaking out weak hands. The question is, are you going to be smart enough to take advantage of it? Or are you going to be like everyone else, watching from the sidelines later this year as silver makes new all-time highs, wishing you had listened? The choice is yours. But don't say I didn't warn you. Stay disciplined. Stay focused. And remember, you enter where others are exiting. You buy where others have their stops. You accumulate when others are liquidating. That's how this game works. That's how wealth is transferred from the weak to the strong. And that's how you position yourself to profit from what I believe, no, what I know, is going to be one of the greatest commodity moves of this entire decade. The sharks are feeding. Make sure you're swimming with them, not running from them. This is William Lee signing off. And remember, I'm here to help you.